Hello friends, welcome to my YouTube channel at OneRajKamal. As you go through this video, do subscribe and press the bell icon so that you can get updates to new videos as they come up. Last week was a pretty busy one for the markets with a lot of economic news and many earnings announcements. Much of the economic news was actually bad, and I'll cite some examples. Q2 GDP came out at minus 0.9%. which was higher than the forecast that briefing.com had at minus 0.5%. And this marked the second successive quarter of negative GDP expectations, given the minus 1.6% number for Q1 GDP. And as we all know, two successive quarters of negative GDP growth mark a recession historically in the US. The PCE price index in June came out at 6.8% in June, up from 6.3% in May. And the core PCE, which means excluding food and energy, came at 4.8%, up from 4.7% in May. See this chart, and these inflation numbers, which have already been marked by J Powell as poor, show broad-based sticky inflation, which is sapping up consumer demand. See the next chart, which shows personal disposable income in real terms, and the real disposable income per capita in the US declined again by 0.3% this month and is now down 3.2% for the year, marking a significant decline in the spending ability of consumers in the US. And we all know US is a consumer-driven economy. New home sales were down minus 8.1% month on month, as you can see on this chart, and pending home sales declined minus 8.6%, and these declines indicate a reducing affordability to buy homes as mortgage rates increase. See the next chart, which shows Conference Board's Consumer Confidence Index, which has now dropped to a multi-year low of 95.7 in July, and expectations are down to 65.3 from an already low number of 65.8 in June. In fact, concurrently came out the University of Michigan's consumer sentiment, and that also remained at near record lows amid persistent worries about inflation and emerging worries about a softening labor market. On top of all this, the Fed increased the Fed funds rate by 75 basis points, and it is now up to 225 to 250 basis points, marking the steepest rate hike cycle in 30 years. See this chart. In the last 3 months, from May to July, the Fed has increased the Fed funds rate by 200 basis points. That's really steep. So what did the markets do in response? Well, the markets rallied. In response to all this bad news, Dow Jones was up 2.97% for the week, as you can see on this chart. S&P 500 was up 4.26% for the week, and Nasdaq was the strongest at being up by 4.7% for the week. In fact, all these three major indices have had a very strong July, with Dow Jones up 6.7%, S&P 500 9.1%, and Nasdaq a whopping 12.4% increase in July. Crypto markets have also been bullish for this entire month, with Bitcoin up 20% in the last 30 days, ETH up 59%, Solana 26%, Matic 95%, and Avalanche 44%. So what's driving this behavior? Well, I think the markets are operating on the principle that bad economic news is good news for stock markets. As all this bad economic news came in, there was something else which was going on, and that is that the odds for a 75 basis points hike in the Fed funds rate in the September meeting of the Fed declined from above 40% to less than 28%. This effectively means that the market expects the Fed to hike by only 50 basis points in its September meeting, as you can see on this chart. The tool now predicts a 100 basis points increase in the Fed funds rate up till December to a range of 325 to 350 basis points, but very importantly also factors in a reduction in the Fed funds rate thereafter, especially around May and June 2023. So the markets are pricing in that the Fed will get its hands forced because of weak and poor economic news, or because something breaks because of their very fast Fed funds rate hike cycle. And as a result of this, Fed's hawkish monetary policy stance will change, and they will begin to cut rates by mid of next year. That is a significant assumption, and that is driving this rally in markets. Last week was also a very important week on earnings, as some of the major S&P 500 bigwigs came out with their earnings and actually rallied in spite of weak reports. See this chart, which shows the weekly performance of some of the bigwigs, and you can see that Google is up 7.6% for the week despite reporting an earnings decline for the second quarter in a row. Amazon is up 10.2% despite announcing a 57% declines in operating income year on year and a negative EPS. Microsoft missed both top and bottom line estimations, but the stock is up 7.8%. General Motors, which is outside the tech sector, reported its earnings at the lower end of its guidance, and this guidance had already been lowered at the start of this month, and the stock is up 4.6%. In fact, many majors have done well this week post earnings, in spite of earnings being weak, with the sole exception of Meta. And by the way, this behavior is similar to what we saw in Tesla and Netflix last week, where in spite of bad earnings, they rallied. And I think effectively what is going on in all of these stocks is that the market had actually priced in much weaker performance, and when reality turned out to be not that bad, and reality was better than expectations, as a result, stocks have rallied. So effectively, last week was a very positive week for the stock markets, because bad news for the economy is being perceived as good news for stock markets. And on top of that, the majors, the big wigs in S&P 500 all showed better earnings than the worst that was priced. So is the coast all clear? This week was important because there was a lot of economic news coming in this week, and there were significant earnings announcements. And if the market had broken to bearish territory, then the damage could have been very significant from there on. Holding up this week is actually good news. I think the positivity should continue for some time. You can see on this chart of S&P 500 that there has been a trend of higher highs and higher lows since the bottom reached in mid-June. See the bottom right of this chart to see the trend line. But I think there are headwinds in S&P 500 at 4170 levels, again marked in blue line on this chart. This is the range around which we had seen the lows of March and the highs of a June rally, and this could act as resistance. If this is breached, then we are in for a longer bullish run. Honestly, I've been more bearish than what the markets have turned out to be, and in that sense, my expectations have not been right. But I still don't think the coast is fully clear. The Fed is hiking too fast, and this could break something. And when something breaks, this orderly logic that the markets are getting into much poorer economic environment, the Fed will change its hawkish stance and become more accommodative, and therefore markets will rally. This orderly logic breaks down. When something breaks, there is panic, and panic reaction is very different from orderly thinking. I think that something is likely to break as a result of Fed playing this catch-up game to a very high inflation because they were slow off the ranks. As a result of this very aggressive and hawkish monetary policy stance and Fed rate funds hike, some skeletons would emerge, and not just in the crypto world. So when skeletons emerge in the real world, there might be some panic, and markets may touch the lows that we have seen in the recent past. So I do expect the markets to have one leg down before I can call everything as coast being all clear. Thank you for joining me today, and I look forward to having you in my weekly market analysis on a regular basis. Thank you.